Today in InvestTalk, we look at the best ways to leverage your home equity. I then look at today's mixed market action. Then I take calls on Energy Transfer, Google, UPS, and more. And at the end, I discuss why the demand for copper continues to skyrocket.
This is InvestTalk, independent thinking, shared success.
Now let's pivot over to my focus point, which is about home equity. I love this topic because this is a source of financial flexibility that many Americans have used for now decades, right? With take out the financial crisis and that mini downturn, generally real estate prices have gone higher. It makes sense. It tends to be a hedge against inflation, and real estate prices tend to go up with inflation. So it's gone up a little faster in many years, just like the last couple. But it's allowing Americans to have some flexibility in how they invest and how they manage their finances. In all, millions of Americans are sitting on a ton of tied up wealth in their homes. The average homeowner has about $330,000 in home equity right now. And if you use it correctly, you can either torpedo your wealth using it or expand your wealth. So let's talk about that. How to strategically tap in to create considerable financial growth. Now, the first thing you have to remember is leverage of any kind is an aggressive stance. And so when you are taking out equity or just having a leveraged position on your home, you need to have everything kind of around it a bit more conservative. Okay. So you don't want to be tapping in your equity to buy Bitcoin, for example. Okay. Or some alt cryptocurrency. So you have to have a clear understanding of the best use for that borrowing, matching your cash flows with your liability needs. Okay. Now, the first thing, I think probably the best use of home equity typically is to maximize the current space you are utilizing, or if you have, excuse me. And one of the best ways to do that is to turn parts of your home into a rental of some kind. I know here, I live in Laguna Beach, California. They're always looking to try to build more housing, and almost any home can add a ADU, an accessory dwelling unit, if they have the room, and the city is going to probably approve it. And so you can carve out a small piece of your home and go rent it out. And here in Laguna Beach, a one bedroom is going to rent for probably $2,500 to $3,000 a month, maybe more. Okay, and that can be a good use of that equity. But maybe it's converting a garage, maybe it's converting finishing a basement, right? And generating some sort of substantial income. It could be long-term rentals. It can also be short-term rentals as well if you want to manage that. So that can allow you to produce steady income that will cover the interest you're paying on that home equity line of credit or mortgage that you took out. Okay. Now, I think the second best use is probably advanced education. Especially if you feel a ceiling in your career. Maybe you want to switch careers. You need some sort of training. You want to go finance, be able to pay for an advanced degree, some sort of technical training, etc. I think that is investing in yourself, investing in your skills is probably one of the best uses of that equity. Now, a lot of people will say, take out money to invest in stocks. I don't typically advise that. It can, if done correctly, be a smart approach, but that in and of itself is taking leverage to take risk. And oftentimes that can come back to bite you. So I probably wouldn't do that very often. What about funding green projects, right? Solar panels, that you can even sell energy back to the grid depending on your local regulations. Launching a side business. I think entrepreneurship is typically a great thing if you have an idea that you think will absolutely work. And then investing in passive rental property, right? Taking that equity, leveraging it, and buying a single family home, a duplex, vacation rental, etc.
Don't miss out on critical market updates. Subscribe to the KPP Premium newsletter for weekly insights delivered straight to your inbox.
Let's take a quick look at the market today. It was overall a relatively flat day. You had the S&P up a whopping 2.7 points. That's points, it's not percentage. So less than 0.1% there. And it was a mixed day amongst sectors. You had financials down after some recent strength. Apple, Nvidia were up a little over 1%. Microsoft and Google were flat. Amazon up 1.3% as well. Meta, the strongest of the Mag 7, up 3.5%. But Tesla, that was down about 1.6% on the day. You had Visa, MasterCard down. What else? Where was some strength? You had healthcare had a little bit of strength. You had Eli Lilly, Merck, and Thermo Fisher up a little bit, but still the sector ended a bit lower. Let me look at biotech. I'm always interested to see. Yeah, that was down today as well. So that continues to suffer after getting that bounce last week. It's starting to roll over once again. Industrials were flat, but like I said, kind of a mixed day. Yeah, overall, NASDAQ was the strongest, 0.3%. Some of the big movers on the day would be Supermicro, SMCI, down 4%, Intel down 6%, Plug Power down 12%, Palantir up 7%, NEO up about 5%. AT&T, I believe they reported some good earnings, and I think they're buying back stock as well. So, and reiterating their cash flow guidance, so that had a good day as well. So that was the market today, kind of mixed, and we're going into kind of light holiday trading as we head into the holiday season. Remember, it's a shortened holiday season. We're already into the third day of December.
Hi, Justin and Luke. I was calling to get your opinion on the stock Google. The symbol is GOOGL. I wanted to get your thoughts on whether the pending litigation, what kind of effect that would have, and what would be a good entry point. Thank you, and I'll be listening to your podcast.
All right, looking at Google or Alphabet, and there's obviously a lawsuit going on with the Department of Justice, and they want Google to sell off Chrome and really break up parts of their business, saying that they have too much power within the digital ad space. And this is something that the current Biden administration is trying to crack down with Lina Khan, really filing lawsuits against a lot of the major tech names. Now, we have a new administration coming in. His first administration was very business friendly. Now, he's spoken, I think, a lot more aggressively, and his picks are certainly, I think, less business friendly. The question is, how much less? Okay, and we know that his VP has spoken a lot about liking Lina Khan and what she's done at the Department of Justice in order to break up the monopolies. So this is definitely, I think, an administration that will be at least a little harder on the antitrust front and more favorable to the little companies, maybe small and mid-sized companies, and less to these large names, especially the tech names, because how much does Google really export jobs? Can you really force them to bring manufacturing back? They don't really manufacture much, right? And so I think these are the type of companies they're not trying to coerce to change their to get them to bring workers back to America. So will they find ways to break up their monopolies? And in many cases, from Google to Amazon and beyond, a lot of these companies have very strong monopolies, and I think that there's a lot of risk here with a lot of the Mag 7 names for the Trump administration to be even harder on them than Lina Khan has been. And so I would be careful. They're already losing momentum. A lot of them. Google peaked in July, and you've seen this really meander between about 150 and 180 since then. And that's in a market where it's trending higher. You also have year end where most people don't want to take gains on a Google, for example. Maybe they're going to wait till next year. And I think there could be weakness into at the start of next year with a lot of these Mag 7 names. So I would not be buying Google at this point. I think the technicals are not in your favor at the current time, and we'll still TBD on what the new administration will look like. Oh, we have a live call. Oh, we're going to go to Ryan in Hawaii. Ryan, you there?
Hey, Justin. Yeah, I'm here.
Great.
Have a question on Roth IRA contributions for the coming new year.
Okay.
Currently have a Roth IRA, and I've been single, filing taxes independently, or filing single. But in the coming new year, I'm getting married in January. And so that'll change my tax filing status. And
congratulations.
I'm wondering, thank you. But it's going to push my our combined incomes above the threshold for contributing, which I think is about $240K. And I'm just wondering, is my Roth IRA, I can't contribute. Am I just going to basically hold it? Or what's in the account now is going to be what's going to stay in there? No more contributions?
Yeah, if you don't qualify, if you you and your new wife don't qualify filing jointly, and you make above the 236,000 level for next year, then yeah, you would not qualify for Roth contributions. Now you could do a backdoor Roth where you're basically contributing to an IRA after tax, and then after tax, and then converting it right away as well. That's something to look into and try to. That's what we do for clients a lot who do not qualify, or backdoor Roths.
Okay, great. Thank you so much.
No problem. Thanks for the call. Let's go take another live call and talk to Sid in North Carolina, looking at UPS. Do you own it or looking to buy it?
I have a less than 0.1% of position, Justin.
Okay.
Thank you.
Okay.
And good evening for taking my call. Thank you.
Of course.
Yeah, I'm thinking of adding more today. Both FedEx and UPS are down for some reason. I'm a little bit honest here, that little attracted with the dividend. And if this is a good entry point, what is your input, please? Thank you so much.
Yeah, so it does pay about a 5% dividend. Now, first off, I would not buy it because of the dividend. Don't think the dividend is why you buy this name. In fact, this dividend has been flat for over almost 2 years now, where historically it's been raising that dividend consistently. So what it's telling you is their business, which has slowed, earned $13, nearly $13 in 2022, slowed to $8.78 last year and $7.47 expected this year, but it bounced back to $8.75 next year. So clearly they got a little bit ahead of themselves, and the business environment was more advantageous back then when people were buying things, right? They were home, they were buying physical products and not going out and spending money on services, et cetera. And there was a lot more discretionary spending for goods back then. And so naturally, their business has done that, what we say many times, reversion to the mean. And you're starting to get to a place where I think the demand for physical goods will increase. So I like what you're looking at, but I wouldn't buy it once again because of that dividend. I don't think the dividend is going to grow. In fact, I could see them cutting the dividend just a little bit based on the earnings prospects. But the profitability of the business is still very good. 32% return on equity. Historically, over the last 10 years, return on equity has averaged 76%. That's a bit high. But it's a very good business. Let's just say that. So that's why I would be buying UPS, not because of the dividend. It has a solid balance sheet, about $20 billion in net debt on $110 million market cap. I think that's fine right there. What are they doing? They also continue to buy back shares, which we really like, that they're buying back shares using that $4.3 billion in free cash flow, which puts it at about a 4% free cash flow yield. Solid. Once again, not amazing. You're yielding 5%. So that's a good example of why that dividend probably, I think it's sustainable. I could see them cutting it in the near term. So don't buy it because of that. Buy it because of the quality of the business, quality of the balance sheet, et cetera. So I'm giving UPS a thumbs up. Thanks for the call. Now, you probably noticed that we are answering questions submitted by viewers to our YouTube channel. This is because we post podcasts in video form each weeknight. And here's one that came in earlier. Justin S9J says, longtime listener from New York. I would love to get your opinion on American Eagle Outfitters. This is one from my younger days where it was popular in the 90s. But he says, wondering if this is a good time to buy for a stake that would be about 2.5% of my portfolio. What sector? With a sector weight of about 11.5%. Okay. So I like that he's talking about that, knowing what sector weight he has of this particular sector, what sector weight he has for this sector, and that this fits in that, right? That American Eagle fits in the consumer discretionary sector. The apparel business is one of those subsectors. Now, earnings are expected to be up 17% this year, 8% next year, to $1.93. That's still down from the $2.19 in 2022 that it earned, but obviously still doing fairly well. They operate 1,500 American Eagle Outfitter stores and Aerie clothing stores in the U.S. and internationally. About a $3.8 billion market cap, so kind of in that small to mid-cap space, 2.5% dividend yield. I'm looking at the chart, and it is in a general uptrend on the weekly, but near term, it's peaked in March. And so I'm going to give it kind of a neutral to slightly bearish, just because it's been in a downtrend for the better part of 9 months now. And I don't like that. And analyst expectations for this year and next year on earnings continue to come down, which I don't like either. So those two factors, trends in earnings, trends on the chart, really put my bias against this type of name. Now, they have a good balance sheet, no long-term debt. I like that. Free cash flow about $300 million. So it puts it on market cap $3.8 billion. So it puts it at about an 8% free cash flow yield. That's pretty good. They are taking they were actually issuing shares recently. I don't like that. Let's see what else. Profitability is good, 14%. But I just don't like those earnings trends. I don't like the technical trend. And I just think there's better opportunities out there within the consumer discretionary space, which you go look at an XLY, which is the consumer discretionary ETF, that's at a 52-week high versus American Eagle being in a downtrend for the past 9 months. So just better opportunities. I would move elsewhere with your money. For more insights and resources, visit us at InvestTalk.com. Let's go talk to Larry here in California. He wants to talk about IRA transfers as well as Meta.
Hello. Good evening.
Yes. Good evening.
Hi, how are you? Thanks for taking the call. Yeah, okay. So my situation, just looking for a second opinion, really. I'm 44, in California. So I left an old employer. It's about $200K in the 401K.
Yep.
So I'm just want an opinion on what's the best option for me. I can leave it at the employer, and it's just in an S&P 500 fund, earning 10%, whatever. But what I really want to do is get exposure to stocks. So I'm with Fidelity, also have a Roth. So I could convert to an IRA. Of course, there's tax implications there.
No.
I already have a Roth with Fidelity, and but I could also roll it over to my new employer and continue contributing with the 20 to 23K. I'm just looking for maximum. Of course, everybody wants maximum gains, but just really want to get into some individual positions. Before I know we're on this bull run. I just want to try and capitalize before it's all said and done.
Yeah. Simple is the first thing you should do is roll it into an IRA. You have a Roth IRA. It sounds like you can. I would open up an IRA. There's no tax consequences of moving your 401k into an IRA. Yeah. It's just an IRA rollover. You can do that. There's no tax consequences. Now, if you roll it into a Roth IRA, there is. What was that?
Yeah, the 200, the 401k is pre-tax. So if I go to the IRA, that's real money, right? That's going to be taxed
No. Listen. When you roll an IRA roll a 401k pre-tax into a traditional IRA, there is no tax consequences. It's only when you roll it into a Roth IRA that there is tax consequences. Okay, that is a Roth conversion. Now, what you can do at some point, you can convert some or all or part, over time of the IRA into your Roth IRA. You don't have to do it all at once. It can be $5 at a time. It doesn't matter. So you can slowly do that over time. And that there are tax consequences there. But you definitely should not roll it into your new 401k. You 100% should roll it into a traditional IRA. Then you talk to a CPA, maybe at some point. What we do for our clients, we run full financial plans and we say, okay, when should you convert your IRA into a Roth IRA and take that tax hit? And usually it's slowly over time. Usually it's between retirement and taking Social Security, et cetera. So those are things that you want to talk to a financial advisor about. You can talk to us about. We can help you with this. We use Schwab. You're at Fidelity. Both are good. But 100% roll your 401k into a traditional IRA. There are zero tax consequences with that. Zero.
Like the new company 401k. Why not just roll it over to that?
Because now you're limited. You said you wanted to buy individual stocks. Right?
Correct.
With an IRA, you can buy whatever you can buy mutual funds, you can buy ETFs, you can buy individual stocks, you can buy individual bonds, you can buy whatever you want, right? And in addition, what people don't realize is that most 401ks, there are investment options, your mutual funds, and those have fees within them. But then there are actual plan fees as well. And it depends on the employer. Some employers pay for it all those plan fees. But a lot of employers share or put the burden entirely on the employees and spreads the cost of running the 401k plan on the employees. And so I don't know, what that is with your current employer or previous employer, but that's why it's usually makes sense to roll those 401ks into an IRA. You still contribute to it's your new company, you get the company match and all of that. If you ever leave again, you roll that 401k into your IRA again.
More, if I could. So going over to that, you say roll it over, but what if I still want to stay not liquid, but I want to in that IRA that's locked in until retirement? I qualify for a pension, so I'm going to have something at the end of the road as well. Yep. But I was thinking maybe a brokerage account may be more appropriate for
whenever you take the money out of the IRA, that's taxable. Okay, when you take the money out of a 401k, out of an IRA, that's a tax event. Do you want to take that tax event? Okay, you have a Roth. Now you can take the contributions of your Roth out at any time. That's where your liquidity comes from. So if you want to contribute more above that and open up a brokerage account, that's fine. But just roll it into an IRA and then start contributing to your new 401k and get rid of the old one. You don't need that anymore. Okay. Thanks for the call. Now let's go take another live call. Sheila from New York looking at Boeing.
Looking to buy. Thank you for taking my call and thank you for the show. It's great. I keep hearing that this cycle is great for industrial stocks, and Boeing is one of the big company, and it's important for military and commercial travel. So has it bottomed yet? Or?
So I do agree that industrials are a fairly good place to be, and that aerospace and defense, depending on kind of where spending goes with the military, I think that's going to be a big question going forward. I think it can be a good place to be. But Boeing, unfortunately, is the worst run of them all. They've lost money in every year since 2019. Okay. Part of that's COVID. I get that. But they're supposed to lose $16 a share this year. They're supposed to make $1.27 next year. I've said this for the better part of 3-4 years now. Until Boeing's leadership is gone, this is uninvestable. It's an uninvestable company. Leadership has destroyed this business from leveraging the balance sheet in order to buy back stock at egregiously high prices. That's number one. Number two is the safety, right? Just there's all these whistleblowers are coming out saying that they bypassed. They were focused more on profitability and squeezing out profit margin than the safety of their product. And at the end of the day, when you make a product, it's vital that you keep the quality and quality up, and you keep the reason why people were buying your product steady. And if you lose that, then you lose your entire business. And Boeing has lost its business. It's lost its way. Now, can it get it back? Sure. But it needs to clean house. meaning all of these C-suite executives that have pun intended, I guess, driven this company into the ground, they need to go. So until that happens, it's uninvestable. You look at the financial performance, it's been horrendous. You look at the chart, it's horrendous. Relative strength is 14. It's below all the major moving averages. Yeah, it's bounced a little, but it's still in a downtrend. And it's $155 stock, so let's make $1.27 next year. Where is the beef? This has a lot of debt on its balance sheet. This is extremely low on the list of the type of industrial or aerospace companies you would want to buy. Extremely low. This is in the bottom 5% of names that are even to think about. Okay, so move on. I like generally what you're saying, but you're barking up definitely the wrong tree because the leadership here is horrendous and needs to go. Until then, it's off the list. Thanks for the call. Let's go to Marco in California looking at Lam Research, LRCX.
Yeah, I'm calling about Lam Research Group. I know it's been on a downtrend, but I have a trend line and it looks like it's closed above that. I just want to know, moving forward, do you see any revenue growth and earnings per share growth?
What trend line? I'm looking at the chart. I don't see any trend line that closed above. Yeah, it had a nice day yesterday, and it was down only 17 cents today. So kind of a consolidation pause day today. And that looks overall fine in the very, very short term. But like you said, it's in a downtrend since July. The semiconductor space has been in a downtrend. This is in the semiconductor equipment business. And so you look at a name like ASML, which the chart looks very similar. And, this is a business that goes through boom and bust cycles. And I think we're probably on the precipice of a bust cycle in semiconductors with so much capacity being built out over the last few years and so much demand recently for AI. Yeah, I think that will continue, but not at this pace. I think it will slow. And so this is not a name that is on our watch list. Earnings expectations for this year and next year are coming down. So I don't see any trend line that you're talking about that it broke above. And I still don't like the downtrend that the whole space is in. So I'm passing on Lam Research.
All right. Appreciate it.
No problem. Thanks for the call. Let's talk a little about the dollar. And President-elect Trump was on social media. And he said, quote, "The idea is that the BRICS countries are trying to move away from the dollar while we stand by and watch is over. We require a commitment from these countries that they will neither create a new BRICS currency nor back any other currency to replace the mighty US dollar, or they will be hit with 100% tariffs." Now, the funny thing here is Trump has talked about a weak dollar, and he doesn't want people to abandon the dollar, which which one do you want? Do you want a lower dollar, or do you want them to keep the dollar? It's kind of puzzling, but we'll see kind of how they try to weaken the dollar along with keeping the dollar the global reserve currency. There are a lot of people in Washington that actually think the dollar as the global reserve currency is detrimental. There's a reason why the Rust Belt is hollowed out. It's because it just creates kind of a perpetually strong dollar. And a weaker dollar would be beneficial to the Rust Belt and a lot of the manufacturing base of the country. And many, including J.D. Vance, have talked about a weak dollar being better. So I think that's very interesting. But let's pivot back to what he said. The dollar rallied yesterday on this tweet over the weekend. And what he's referring to are the BRIC countries: Brazil, Russia, India, and China, and South Africa. There's also others that have gotten into kind of this alliance to a degree. And they're not talking about their own currency. What they are really talking, though, is a cross-border payment system that would get around the SWIFT system. And mainly this is a part of Russia's way to avoid sanctions. And, a lot of countries, not just Russia, are worried about the U.S. seizing assets through the SWIFT system. And if suddenly they're not using the SWIFT system, then the U.S. has less leverage financially when maybe certain countries act against the interests of the United States. And so that's really what they're trying to do. Now, China is trying to use the yuan as a potential rival, but that growth has been very, very slow. In fact, if you look from 2020, October 2020, about 85% of global trade finance was in dollars. It's gone down since then, but it's at about 82%. So 85 to 82. And that pretty much has entirely been moved to the yuan. Actually, the euro has shrank over that time as well. So there is some gains there, but still, the Chinese yuan is about 6% of global trade finance. 6 versus the dollar, 82. Okay. So there's not really much traction there. Now, what a lot of these countries are doing instead is actually diversifying a lot of their foreign reserves, especially central banks. They're moving out of dollars and dollar-denominated assets into things like gold. One of the reasons why gold continues to move higher. They're also moving to other foreign currencies as well. And so while they're trying to do this, I don't think they're really trying to move away from the dollar itself as much as they're trying to move away from the SWIFT system to avoid the prying eye of the US government and their ability to crack down, create sanctions on various countries like Russia, like China, potentially, if they move on Taiwan. And that's something that I think will continue. I don't think that's going to change. I don't think Trump can really do much about that because, once again, it's not really creating a currency. They haven't even talked about a BRICS currency. They're talking about a payment system. And maybe he cracks down on that. But it's so small and it's been growing already and has some momentum. And in the end, if they want to get around it, just buy gold. Gold is the ultimate go between because gold is accepted everywhere. And so I think that is the new BRICS currency, and Trump can't stop them from buying gold.
Thanks for joining us.
If you found this helpful, please hit the like button and subscribe for more future videos.
Hi, Luke and Justin. Long-time listener here from the Midwest. Love the show. You guys are great. I have a quick question for you, please. I'm interested in the stock ET, Energy Transfer Partners. I guess I feel it's a stock, or can you tell me, is it an energy index fund or something that has multiple stocks in it? I'm interested in getting involved in energy. I think that'll still be something good for the future. I'm not even quite sure of that, though. Do you feel that would be changing or not? Has it already had its run? I've heard you talk of ET in the past, and I think you give it a thumbs up. I'm not sure, however, if I should stay in energy or if you guys feel that industrials would be better for the future. I've heard you speak of that one highly also. Thanks for your time. Look forward to hearing your answers on the show. Have a great day.
Well, I think you should have both. I don't think you should pigeonhole yourself into one particular sector of the market. That's called lack of diversity. But you certainly want to be overweight certain parts, including industrials. And I do think energy, but energy is wide ranging. You know, there are oil service names or energy and production facility or companies, and then there are pipeline companies. And I would say Energy Transfer fits into the latter. It owns one of the largest portfolio of crude oil, natural gas, and natural gas liquid assets in the United States. And it has a pipeline network of total of 130,000 miles. It owns gathering and processing facilities, and it's benefiting, and it's gone up recently after the Trump election win. And that's because the idea is that there's going to be more drilling, and more drilling means more product moving through these pipelines and more fees being produced by Energy Transfer and other companies that own these pipelines. Now, we own a different pipeline company we've had for a long time that we think is the best in the space. And we would rather own that one. But Energy Transfer is good. Now, one thing you have to understand is it's not a traditional stock. You ask this, is it a fund? No, it's not a fund. It is a limited partnership. So it's not a corporation. It's a limited partnership. And that means that when it pays a dividend, its current dividend is 6.7%. Its current dividend yield 6.7%. That is not a qualified dividend. That is taxed at your ordinary income tax rate. You also get a K1. Okay, and you can't, if you own and you receive more than, I believe it's $1,000, these tax rules change per year in a tax deferred account like an IRA, a 401k, you get a separate K1. It becomes more of a mess here. So understand the tax implications of owning a limited partnership. If you don't get that, if you don't have a clear understanding of that, then you don't want to own this name. Okay, but if you're comfortable with that, being a limited partnership, Energy Transfers is just fine. Like I said, it's one of the largest in the space, $66 billion market cap. And they do have, a lot of debt on their balance sheet, but that free cash flow is it's heavily capital intensive. And so that's why they have a lot of debt. Once again, I think there are bettors within this space, but this is certainly a good one to own. Thanks for the call. Now, lastly, let's talk a bit about copper. And what's interesting here is that copper is widely recycled from all types of material, things like chewed up cars, computer cables, etc. And Glencore, one of the largest commodity names in the world, they are expanding their ability to recycle products, usually electronic products, to pull the copper out for everything electrical. And the Glencore's global head of recycling says in the next 25 years, we will consume more copper than humanity has consumed until now. Think about that. In the next 25 years, we will consume more copper than humanity has consumed until now. And that means that copper consumption is skyrocketing because of the Inflation Reduction Act, the CHIPS Act, etc. You have data centers being built and artificial intelligence. All of that is demanding a lot more copper. And Glencore estimates the global copper supply must grow by 1 million metric tons a year through 2050, which means annually adding the equivalent of the world's largest copper mine down in Chile. So I wanted to highlight that because you can see these commodity companies are gearing up to try to produce more copper, and it shows that there are major problems, and that's why copper remains the best green metal to invest in by far. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number by heading over to investtalk.com. Click on the portfolio review button. It's a free and confidential service. And if you haven't optimized your 401k potential, we can help there as well. Once again, start at investtalk.com. Independent thinking, shared success. This is InvestTalk. Good night.